we're going to discuss the path of interest rates on society. In recent years, we've seen interest rates patterns floating between negative and a half a percent. I don't see this changing anytime soon. In the 70s and 80s and 90s, Alvin Toffler, John Nesbitt, and many other noted socioeconomic trend and pattern recognition authors wrote about this phenomenon that we're now seeing. Further concrete articles came out in the 90s depicting how the Internet of Things, if you will say, would reduce inflation for the long term. That seems to be what we're seeing. However, as opposed to the actual decrease in price of a product or a good, we're actually seeing an increase in utility of the goods that come out, which allow us to be more productive, more efficient, and do more. However, that alone does not account for the deflationary pressure. It's the combination of the internet and the demographics combined that have led us to an inevitable pattern of low inflation or deflation, and hence low interest rates, giving the Federal Reserve very little room to battle these issues. For these types of reasons, governments who manage societies would be extremely smart to take advantage of investing in their infrastructure, technology, and education in order to harness the power of the economies of scale that they would actually get by spending money in those areas. And if a society fails to take advantage of these types of financial environments, then the status of the global chaos increases from current levels, and we see decreases in standards of living. We have typically seen this in the United States, where the middle class income has come down considerably. The internet has really brought about some fierce competition, which has limited pricing powers of companies. The commodity price cycle boom of the first decade of the 21st century has led to decreasing input costs. Demographics have led to a lack of pricing power due to a lack of demand for certain life type purchases. These would be large purchases, items such as housing, which is driven by family formation as a result of the millennial generation living in the basement of their parents' home in order to save money because they have a lot of educational debt, as a result of the baby boom generation already having their houses paid for and their large purchases paid for. They're not spending money either. So that phenomena has manifested itself into this lack of demand, this lack of interest rate power, and the lack of pricing power. I don't see these factors abating anytime soon. In addition, overinvestment in many industries and asset classes in the economy have led to overcapacity and underutilization. So when that happens, you get excess capacity, volatility in equity prices, and an inability of the stock market to drive forward. We saw this in 2001, 2002, 2003. We saw this in the end of 07, 08, 09, and into 10 as then the market began to recover. The drive for production of alternative fuels and energy since the 1970s has increased exponentially, which will eventually lead to reduced input prices from the oil service sector side of the economy. Fixed overheads, which create opportunities for margin expansion without increasing price, is another area that will manifest itself as the equipment from these large oil producing companies making themselves available into the market, and we're able to take advantage of the economies of scale and utilities of those assets features. As a result, debt management is very key to a society at this point. However, all of this can make taking on debt less costly and reduce the risk of such if it's managed properly. This is also where the opportunity exists. So, in conclusion, in this type of environment, confused management, entrepreneurs making decision making more difficult, not to mention the challenges of planning and budgeting have all gone into an uproar. And the market volatility over the last, let's say, since 2000, 2001 till now has been very large. The volatility index, or as it is referred to, the VIX, has ranged anywhere from single digits to 70. In order to succeed, companies and governments must work together on an acceptable level of government given a capitalistic economic environment. The challenges in legislative process have hindered this partnership between the public and private sector, unfortunately. The legal system is very latent. It takes a long time to enact laws and enforce laws, and therefore, for the tax base and the tax revenue to keep pace, states have had a very difficult time, as well as the federal government, in providing revenues for these infrastructure type projects. This vicious decrease in inflation and increase in deflation, hence a degradation of the GDP, can be solved. Although we do see inflation in what I call pockets, you get industries such as insurance, where inflation has been huge, which is a large part of the economic pie to the family unit, as well as the corporate unit. However, it will never be solved if people do not embrace the synergy required between governments and people it serves. At the moment, it seems that there is a self-defeating behavior manifesting itself. However, these self-defeating patterns can also be methods of corrections if intentions are good. It all depends on how you perceive things, and perception must be coherent, strategy must be coherent for there to be a positive outcome. Basically, what that means is a two-party system. The Democrats and Republicans need to get together and think about what they're doing in order to solve these problems as we move forward in time, so that we're able to take advantage of the path of the interest rates, which the pressure is flat at best at the moment in time. The Federal Reserve right now is somewhere around 1 to 1.25 in its federal funds rate, and that pressure to move up is abating with the onset of the unwinding of the balance sheet. So therein lies the great challenge